Hello and welcome to this latest edition of Courses on Demand brought to you by Forex Academy. In this course, we will be discussing Introduction to Fibonacci. There is, of course, inherent risk when trading the financial market. So just before we do begin, please take a moment to familiarize yourself with the following disclaimer. So in this lesson, what we hope to cover is really develop a basis with the introduction to Fibonacci. What is it all about and how do we use it as a technical indicator? We'll discuss its mathematical significance, and it does actually have some significance in many walks of life in nature. We'll discuss it as a technical indicator in relation to its support and resistance. So that is really what it does. It looks for these areas within the market that we can look for trading opportunities and congestion of price action around levels of support and resistance. We'll be really discussing how to use it as an indicator, looking at these Fibonacci levels, how to use it from high to low in the markets, and how significant it can be as a technical influence on our trading. And then we'll be discussing some of the limitations, obviously, as a technical indicator. Many other technical indicators, as technical analysts, we know and accept that they have various limitations. We'll discuss the limitations of Fibonacci retracements themselves. So let's delve into our introduction to Fibonacci retracement levels. These levels are very important to technical traders as they highlight long-term support and resistance levels that often identify potential market reversals. It is perhaps one of the most commonly used technical indicators, and as such generates additional interest when the market trades in and around these levels. Okay, so as technical traders, we are aware of these levels within the market, and that actually generates an additional level of interest and is often a self-fulfilling prophecy as price movement tends to react quite volatile and shift away from such levels. As an indicator, it is more applicable to trading longer timeframes and is not suitable for trading shorter time frame analysis, for example 5-minute price action charting. Okay, however, given its objective in identifying potential reversal signals, it does work much better in markets that experience long-term volatility and continued price change. And we will discuss this in much more detail throughout the webinar. It is much more applicable for those markets that experience volatility. Obviously, if we're looking to trade off levels where we see market pullbacks, we see levels of contraction, and potentially look to buy from those areas if it's selling off in that direction, that volatility will actually give us opportunity with our Fibonacci retracement levels. So these Fibonacci retracement levels, they alert traders to possible support and resistance areas in the market. A possible reversal is based on the prior move. Okay, so we're looking potentially for market pullbacks to reverse the trading decision. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. When a market pullback occurs, technical traders identify retracement levels for monitoring. Okay, and because, as I said, they are a self-fulfilling prophecy, many traders are speculating in and around these areas. We know how they're going to react. Let's say potentially the market is trading at all-time highs and it pulls back to a 50% a level of retracement. We know that is very significant and an area where many traders are indeed monitoring. The Fibonacci retracement has, of course, mathematical significance. It derives its values from a series of numbers, and these numbers were developed by Italian mathematician Leonardo of Pisa there in 1175 to 1250. So those are the Fibonacci numbers there, ranging from 1 to 144, and of course they continue in the Fibonacci sequence. They are very significant, and we often see them in many natural universal proportions. Both mathematicians and scientists conclude that they're significant. You can see them, and as you look at the image there to the left, it resembles almost a shell-like picture that you could see on a beach with the formation of the swirl, the Fibonacci swirl, very famous indeed. They are important to us as traders as they can identify these possible levels in the market, support and resistance. Traders often trade these levels or look for breakout opportunities. So when we see them bounce from support to resistance within a level, they can often range, and that can cause range-bound opportunities for a long, consistent period of time. Or perhaps when these eventually break down, we can look for these breakout opportunities. There is an acknowledgement of such levels often because trading congestion leads to, I suppose, a lot of interest within the markets at these key Fibonacci levels. That's generally what we'll see. There are a lot of speculative traders looking to trade these levels, and as prices congest down to these levels, that's why you often see a breakout after a mature trading trend almost expires from the level. You can see a quick shift, a quick burst of volume in and around these levels. So they're technically very significant. Let's discuss our Fibonacci levels as technical support and resistance for a moment. In identifying genuine levels of support and resistance, this obviously helps traders to discover both floors and ceilings in the market. Okay, so these prices are often supported by floors and resisted by the ceilings. Just like our house there, we have an image of the house where the floor is actually supporting, say, your body weight and everything in the house, and the ceiling would be resisting anything from the outside, perhaps weather or rain, anything like that, a downward pressure on the house itself. These levels are particularly important over long periods of time. They are never a sure signal, just like many other technical indicators. Prices often break through such levels with strength, and we see that as a breakout. And where exactly, this is the common question we get asked as trading educators, where exactly should support and resistance levels be placed in the markets? So here we have a gold market, and we can observe just technically where we can actually see our technical levels of support and resistance. And it's really not too difficult a question to ask. Why do we choose these levels of support or resistance? Well, as we look at the gold market, we're looking at the daily candlestick structure, albeit it's over a long period of time. We can see that there are very significant areas or inflection points within these markets. We can see we have a long time high in and around where we have our level of support at 1356. And of course, we have some very strong bounces from such an area. So what I'd like to do is actually highlight some of these areas within the market here. These areas, of course, going whole way back to 2014, it's technically significant for us. It is a long time high in regards to the last 3 years of price action. And obviously, the market has concluded that it cannot break these highs for a long period of time. That would lead us to believe that this level of support and resistance at our 1356 level is technically significant. Now, we can see throughout that there are some very important price inflection points. Here would be another level where we can see, yes, the market traded down all but a few times, but it bounced quite strongly from these levels. It did break it on several occasions, but you can see over the long term, it does provide some real technical support, and we get some very consistent bounces from the area. These areas can then, or these bounces can actually only last for, I suppose, a short period of time. As we see, our next level of support holds up quite well over many significant areas within the market. So these are genuine levels of support and resistance over the long term in the markets that seem to hold up quite well. How does this relate in terms of establishing Fibonacci retracements? Well, that is the real focus of Fibonacci retracement. It is to look for further levels of technical support and resistance that can give you more evidence to actually look and trade off these areas or levels. So as I move across to another price chart here, this is the dollar yen daily chart. The question I would like to pose for us technical traders is, how do we identify genuine levels of support and resistance within the markets? Well, let's try and look and just visibly see for a moment if we can see some highs and lows over the price action that can give us our own identifiable levels of support and resistance. Obviously, in observing these price action charts, we can see initially that some will be more significant than others. So here we have three very strong structured highs and lows within the markets, and they're providing some technical support. And within this technical support, we have about a few various bounces that are providing perhaps some shorter time levels of support and resistance. So just by observing the price action chart, what we can do is look at these previous highs and lows existing in the markets to give us some technical genuine levels of support and resistance. Let's look at identifying these technical support and resistance areas over asset classes here. And what we have in front of us is the German DAX. It's an equity index in Europe, and we have daily price action from left to right. We can see already we have placed an overlay of some genuine levels of support and resistance. Again, they're based on previous highs and lows, which give us a very strong inflection points within the markets. What we can see here is that we have a ceiling that is actually providing resistance over a sustained period of time. And as the market trades up through and breaks that level, that ceiling then becomes a floor in the market. So it's very important to note that as we trade the markets can break through these levels, and obviously once the breakout occurs, that previous level of support and resistance has actually faltered and can actually change or shift to become a new level of support or resistance in the market. That again provides us with trading opportunity as we look to more relative price action. We've seen a very strong break to the downside in this German DAX market, and that breakout opportunity has moved quite swiftly in terms of the price action. And that's generally what can occur in these markets. We've seen the floor here. It provided support over a sustained period of time. The market then traded up to new high, reverted from new highs, and with that weakness, looking at the structure of that Japanese candlestick, we see a very strong, consistent break through to the downside of our new floor. Here we have the gold market in front of us. Again, if we look at the price action, it's daily candlesticks moving from left to right over a long, consistent period of time. What we can see is a technical overlay is actually our Fibonacci retracement, and it is extending from a recent high to low point. So that's how we actually use these Fibonacci indicators. We look for a recent real high or low point, or a high to low, and actually stretch the indicator from those areas. That stretches across our Fibonacci retracement levels of support and resistance. So it creates these retracement support levels as a function of the Fibonacci numbers. As a technical indicator, it works better for particular asset classes, and we will discuss that again in more detail. And the question I would like to pose is, what happens next? We can see the blue circle indicating our most relative price action, and it is at our 23.6 Fibonacci retracement level. Well, what happens next? We know that there could be a significant move from this level. We could see a bounce up to new highs again, or we could see the price breakdown from our Fibonacci retracement level right the whole way down to 38.2, potentially lower, over 50% retracement level. So let's branch across to a different asset class here. Here in front we have the US dollar ZAR, and the question again I would like to pose here, where exactly do we place the Fibonacci retracement indicator? If we remember back to the previous slide, we're looking for a high and low within this market, something that can give us a real genuine sight as to where the Fibonacci numbers may be significant. We're not looking to perhaps pick a high and a low from the past week. We're looking for an overall genuine level of price inflection over that consistent period of trading. Looking at these daily candlesticks, a high and low that can give us a subjective level to where the indicator is more observable. So here, as we input our indicator into the market, we can see the most recent long-term high and the most recent long-term lows are the most significant areas in which to place this Fibonacci indicator. So let's delve into the actual study of Fibonacci retracement as a technical indicator in terms of what it means for our trading. Notice that I've used this market before quite a few times, the gold market, because gold is quite significant in terms of technically adhering to the Fibonacci retracement level. And again, I wanted to use this because it is a good example to use the indicator and actually applying it to the markets. Notice in this chart now that I have my Fibonacci level as the second most recent high there, and I wanted to really give you this as an indicator in terms of how price action moves as we look to trade. So let's just say, for example, we begin trading where we have our begin trading point marked. How could we look to perhaps trade this in terms of looking for levels of support and resistance, pullbacks within the market, and actually looking to trade corrections or bounces from such levels? Well, we have here our green circles here, which actually give us very good, strong signals to trade this market. We can look to buy or sell as the market trades up or down between our indicator levels. So very good term structures indeed. But notice again that we have some areas where the signal actually is a poor signal, and it actually gives us some losing trades if we decided or had it decided to take these trading positions on. So there is a level of inconsistency with the indicator itself. And if we had started at our begin trading signal there, we would have made various good trades and a few bad trades as well. So there is that level of inconsistency. Again, as we approach our most recent price action, the question is often, well, what happens here? What's going to happen next? And all we can do is observe the price action as technical traders. We're looking for clues in perhaps the structure of the Japanese candlesticks, to perhaps volume and momentum shifts, to see if we can get more of a signal that this market will actually bounce from this level or break through it. We know that it's technically significant and that many other traders are focusing and monitoring their technical trading decisions around this retracement level. It is the awareness of these Fibonacci levels, therefore, that the markets often focus their attention on. This can then become a self-fulfilling prophecy as traders observe price action around these levels. And that leads us nicely on then to discussing the limitations of Fibonacci retracement as a technical indicator. The underlying principle of any Fibonacci tool is only a numeric anomaly and is not grounded in any logical proof. And that is a very important point to make there, guys, okay? Just like any other indicator, the Fibonacci retracement is not a standalone signal that we can use for trading decisions. We could potentially look for these levels of support and resistance, of course, and look how a price action trades around these areas. Perhaps congests, perhaps there's more volatility, perhaps there is more volume. But we can see that it is inconsistent in terms of providing us with assured signals or logical proof that this market is either going to reverse or look for sustained movement from a breakthrough. So it is only one indicator, and to be coupled or used to try and heighten your probability of a trade. The indicator is not applicable to all asset classes, and that is one of the reasons, of course, why I chose to present the Forex pairs in the gold market again, because those markets are quite volatile. Over the long run, they can see shorter term shifts in sentiment, they can see shorter term shifts in trend status as well, and that's what we're looking for. We're looking for potential pullbacks in these markets where the Fibonacci retracement can be met and actually look for trading opportunities. Again, if I use the example of an equity market or an equity market bull run, which we're actually seeing in the markets now, we aren't given the best opportunities in terms of seeing these long-term corrections or volatility to maybe get as many trades off from our long-term high to low in Fibonacci retracement. Perhaps if we see a real structured correction in an equity market, that can give us a signal to maybe look for a pullback in the Fibonacci retracement. But as we know, the volatility isn't as such that we get so many variants of price action over a long-term price action chart when observing the equities. So as an indicator, it is not as applicable to observing such asset classes as equity markets. Fibonacci retracement only points to possible corrections, reversals, and counter trend bounces, and struggles to confirm any logical buy or sell signals. And that is very significant for us as traders. We know that we're very much concerned with trying to find these big moves in the market. If you're particularly a long-term trader, you're looking to either buy or sell the market and have a directional bias in the long term. The Fibonacci retracement, given that it's looking for pullbacks or market reversals or counter trend bounces, it's looking to find that volatility, to find perhaps opportunity within the volatility, and doesn't actually give us those buy or sell long-term signals in the markets. So that's very significant in terms of trying to trend trade. It doesn't necessarily help or aid your decision making whatsoever. And of course, it can experience a high degree of inconsistency. This is something we've seen even by observing the price charts throughout the webinar. We've seen the gold market, how it was providing us with some very good signals. It was providing us with some poor signals that would have led to some losers, of course, as well. But that's part and parcel of using these technical indicators. They are not always an assured sign of a high probability trade. They can often be quite inconsistent. And that's why, as technical traders, and certainly when trading Fibonacci retracements, it is advised to look to use many of these technical indicators to really stack the odds in your favor in terms of decision making as a technical trader. Okay. So that brings us to the end of this Introduction to Fibonacci webinar. Let's have a quick review of what we've actually learned. Obviously, in discussing both the Introduction to Fibonacci and mathematical significance, we know that it is derived from the mathematical significance, really, of the Fibonacci sequence or numbers. Those in turn give us an outlay which we can stretch on to our price action chart, and they help us derive technical support and resistance. Now, there are observable in price inflection points, long-term price inflection points that we can look to add our own genuine levels of support and resistance. If we can use perhaps the Fibonacci retracement levels across these price action charts as well, that can help us give us another signal to actually looking for mathematical levels of support and resistance. So that could look to couple upon really giving us more probability in terms of a possible level or genuine level within the market. We then went on to actually express these Fibonacci retracement levels across various asset classes. So we looked at the gold market and some Forex pairs and highlighted some trading opportunities there. And that led us nicely into discussing the limitations of Fibonacci retracement as an indicator. It is often providing us with some very well-structured levels of support and resistance in the market, but perhaps is at time very consistent with its trading opportunities, given that it gives us good signals and some false signals as well. So that brings us to the end of this webinar. Thank you very much for joining us on this installment of Courses on Demand brought to you by Forex.Academy. We do hope to see you very soon. Bye for now.